In May 2026, a new financial phenomenon is taking over Wall Street and Reddit at the same time: prediction markets. Platforms like Kalshi, Polymarket, and others are now allowing people to bet real money on real-world events. Will the Fed cut rates in June? Will OpenAI launch a new product? Will a specific company get bailed out? Will a war end by a certain date? Major hedge funds are using these platforms for hedging. Retail investors are using them as casinos, and legal battles are raging over whether they're betting, investing, or something entirely new. Even Pope Leo just weighed in this week, warning about AI's impact on financial decisions and job markets. Here's the seductive part. Prediction markets promise something incredible: the wisdom of crowds pricing reality more accurately than any expert. If 73% of traders bet on something happening, the theory says it's 73% likely to happen. People are quietly making and losing fortunes treating these markets as financial truth. But here's the question almost nobody is asking. Are prediction markets actually predictive? Or are they just sophisticated gambling dressed in math? A book published in 2001, long before prediction markets existed, gave the most devastating answer to that question. The book is Fooled by Randomness by Nassim Taleb. Today I'm reviewing it honestly. What it gets right, what's brilliant, and whether its message saves you from the prediction market's boom, or whether the new platforms are different. Welcome to Earnings Per Page, where I distill the world's best finance books into honest breakdowns. Hit subscribe, let's get in. First, the core idea. Taleb's whole thesis can be summed up in one sentence: humans are extraordinarily bad at telling the difference between skill and luck. We see a successful investor, we assume skill. We see a failed business, we assume bad judgment. But Taleb argues that randomness plays a much bigger role in outcomes than anyone admits. And we systematically attribute random success to genius and random failure to incompetence. This single insight, applied honestly, changes how you think about every financial decision. Lesson 1. The survivorship bias trap, Taleb's most famous example. Imagine 10,000 people each flip a coin every morning. Heads they win, tails they lose. After 10 flips, you'd expect roughly 10 people to have flipped heads every single time. These 10 people, statistically, are guaranteed to exist. Now imagine you only meet those 10 winners and ask them their strategy. They'll tell you elaborate stories about why they won: superior intuition, hard work, talent. They sincerely believe these stories, but the truth is they got lucky. The same dynamic plays out in finance every day. We celebrate the lucky few who survive. We forget the thousands who tried the same strategy and lost. Now apply this to prediction markets. The traders winning today and tweeting about their genius. Most of them, statistically, are just at the lucky end of a distribution. Eventually, regression to the mean catches up. Lesson 2. Black swans. This was Taleb's preview of his bigger book. A black swan is a rare, high-impact event that nobody saw coming and that completely overwhelms normal probabilistic thinking. 9/11, the 2008 crash, COVID, the dot-com bust. Each of these blew up sophisticated probabilistic models because the models assumed the future would look like the past. Prediction markets have exactly the same vulnerability. They might price common events well, but they radically underprice the unusual ones. And in finance, the unusual ones are where you actually lose everything. Lesson 3. Asymmetric outcomes. Payoffs over probability. This is Taleb's most actionable idea. Don't focus on probability. Focus on consequences. He gives the example. Bet A, 70% chance to win $100, 30% chance to lose $1,000. Bet B, 30% chance to win $500, 70% chance to lose $50. Bet feels better, higher probability of winning. But the math shows bet B has a much better expected value. Most people choose A. They focus on how likely the outcome is, not how much they win or lose when it happens. Prediction markets exploit this. They make probability feel like the only number that matters. They downplay the size of your losses when you're wrong. Lesson 4. The narrative fallacy. We're storytelling creatures. We see random events and instinctively construct narratives that explain them. After a stock crashes, every commentator has a clear explanation. Before the crash, the same data was interpreted as bullish. Prediction markets feed this. When the market moves, traders construct explanations. They feel like they understand reality. They don't. They're seeing patterns in noise. Now, does the Fooled by Randomness framework actually apply to 2026 prediction markets? Honest verdict, the fundamental insight applies powerfully. Most people who profit on prediction markets, especially retail traders, are confusing luck for skill. They'll have stretches of wins. They'll feel like geniuses. Then regression to the mean will arrive. But, and this is important, prediction markets aren't entirely worthless. For very specific binary events with deep liquidity, will rates go up next month? For example, the crowd really does sometimes price probability more accurately than experts. The danger is treating them as oracles when they're really just collective guesses with money attached. The book's warning isn't, prediction markets are scams. It's deeper. Don't confuse a probabilistic forecast with certainty. Don't bet what you can't afford to lose. Don't assume your wins prove your skill. And don't let losses convince you randomness defeated you. Now, what I disagree with in the book. 3 things. First, Taleb's writing is famously combative and arrogant. He insults entire professions. He mocks people who disagree. The ideas are brilliant. The tone wears thin by chapter 10. Second, the book is repetitive. Taleb makes a few core points and circles back to them in different ways throughout. You could absorb the entire framework in a long, foam article. The book stretches it. Third, the practical application is harder than the diagnosis. It's easy to say, don't fool yourself about randomness. It's much harder to actually structure your financial decisions around accepting deep uncertainty. The book is much better at warning than at building. Final verdict on Fooled by Randomness. Should you read it before touching prediction markets? Absolutely yes. It's not the most actionable finance book, but it might be the most psychologically protective book ever written about money. My rating? 9 out of 10. Loses a point for tone and repetition, but the central idea, that we systematically misjudge luck and skill, is one of the most important truths in finance. Practical takeaway. If you're tempted by prediction markets, Kalshi, Polymarket, or any platform promising you can profit from being right about the future, read this book first. Treat any wins with skepticism. Track your record honestly over hundreds of trades, not dozens. And remember Taleb's brutal core insight, being right occasionally is not the same as being skilled. The whole point of randomness is that it generates winners by accident. Don't be the lucky coin flipper who thinks he's a genius. If this saved you from a prediction market loss, subscribe to Earnings Per Page. Next week I'm breaking down a book on how to actually invest with proper probabilistic thinking, separating real skill from lucky outcomes. Drop a comment with whether you've ever placed a prediction market bet. See you in the next one.